First of all, we'd just like to start with this panel, and we'll start with everyone introducing themselves. Dieter, we'll start with you at the end. Tell us a little bit about yourself, your company, and then Brendan, and we'll move on from there.
Yeah, good morning, everyone. Dieter Knittel is my name from PBB Deutsche Pfandbriefbank. We are doing CE lending for over 25 years. And this is Poland. We are doing this in Poland, Czech Republic, Slovakia, Hungary, and Romania.
Okay.
Morning, everyone. I'm Brendan O'Reilly. I'm the Managing Director of Fashion House. In Poland, you may know us better as Liebrecht and Wood, which is our mother company. We're involved in the development of outlet centres, offices, and residential.
Okay, and James?
Hi, James Turner, Sierra Belmain. Just passed our 20th year last year in Central Europe. Principally, I guess, retail shopping centres, but obviously that world is broadening a little bit, and we're doing a lot more sort of mixed use and partnering with a variety of new partners this year. So yeah, that's us. Ada.
Ada Valentag, Nud. We are the service provider of property and asset and development project management services for our main customer, Citrus. We used to be Citrus, but then they divided us. And but also to Auchan and to Leroy Merlin and other investors and developers. So yes, basically this is our scope. Thank you.
Frédéric Rouleau, I'm from Multi-Poland. So I am the managing director for Poland, Ukraine, and France. Multi Corporation is a Dutch company. Multi has 40 years history as a developer, manager of shopping centers, also in other asset classes, but mainly in shopping centers. We are present in 14 countries, Europe and Turkey. In Poland, we are serving a third party. Our, I think, best achievement was Forum Gdańsk that we sold 1 year ago, almost.
Yep, Hubert Abt, Workcloud24, German company. It's an ESG monitoring company. Everybody's asking, what is the ESG monitoring company? You ask me that later. I'm happy to explain. We help customers in all asset classes to get the challenge to ESG compliance done.
Okay, great. So, and of course, if you have any questions, we've got a nice hostess here that will hand you the microphone. Just please raise your hand, and we'll take questions anytime during the panel. Dieter, let's kick off everything with you. There's always a lot of talk about banks these days and what's happening with them. Tell us about how you see 2024, what you're lending on, what you're not lending on. What are kind of the middle range there? I hear different things from everybody, so
yeah,
good to hear it from True.
No, I mean that's what everyone is always asking, right? Where do the banks stand? What about liquidity? I mean, you hear it at the moment. Also, capital markets are to a certain extent shaky. What we can say is, I mean, that no one anywhere is raising concerns about the CE markets, and that's great news. Yeah, so I think most of the banks, they have over-exceeded budgets last year, so they have done a lot of business, mainly in all asset classes. I mean, it's not anymore the case that really it's focusing just purely on logistics. I mean, this is still a very important market, and you see it at the moment. I mean, green bonds, are issued also at the moment in the logistics sector, but also banks are looking at retail, for example, if it comes to standing assets, because of course, what you can see is, you don't see any transactions in the market. Of course, it's great that you sold the asset 1 year ago. And also you see right now, you saw Arcadi, for example, sold in Prague for a couple of days ago. That's also great news. But that was South African money or local money. That's what you see, a few transactions. But overall, banks are mainly focusing on extending their loan book. And this is a massive amount of what they are doing. But in terms of new business, they are really looking at all asset classes. And that's also good news. It's not anymore, and also including retail.
And I know, kind of during lockdown, retail was at the bottom, hotels were at the bottom, and now it seems like very quickly it's bounced back. I mean, from a banking and a lending point of view, how do you see
No, that's
the
right.
risk?
Because the thing is, I think it's more clarity about where the pricing should be for retail, probably, especially for retail warehouse. I mean, retail parks, probably shopping centers. It's still a question mark, and I mean, overall, it's financeable. It's tradable because I mean yields are higher than in other asset classes. Other asset classes, I mean, they had to move up quite significantly. I mean, of course, not such a big move as you saw it in Western Europe, but it has to be a bigger correction, especially on the office side. For good office buildings, but on retail, I think more or less the right pricing was found already, or at least it goes into the right direction. And of course, that helps that you see potentially, as I said, the one in Prague right now. Probably also local investors are looking more for higher yielding assets, and that's why I think retail at the moment probably is, at least for example in the Czech Republic, I think the most relevant asset class these days. I mean, if you talk there to brokers, everyone is saying, okay, well, we are quite busy with retail, and this is probably the preferred asset class at the moment in comparison to the other ones.
Yeah, kind of amazing how it changed so quickly. And also, even on hotel side, not that we're doing a hotel conference, but so many investors are now buying resorts where before no one was talking about resorts from that sector. One other question before we move on is, we were just at the CBRD conference 2 days ago in London, and many of the comments were, it's a disaster in Western Europe. Germany has all these problems. France has all these problems. UK, disaster. But CE is fine. But how do you see this? I mean, it must be a little bit of a tsunami coming, or how do you guys see it as a bank? If you have big problems in Germany, it can't be that happy here, right?
No, I mean, of course, I mean, it doesn't help because always, I mean, Germany was a strong factor. Right now, this is to a certain extent not gone because, I mean, it's a huge country and you have a lot of exchange between all the CE countries and Germany. And I mean, of course, everyone is talking about it. And I mean, let's see. Of course, I mean, energy prices, all that, I mean, that has a big influence, especially on Germany, and that doesn't help. But I think, of course, I mean, it will getting better probably in 1 or 2 years' time. But at the moment, they are lagging behind. And of course, still the US market. And that's what you see. But that's the good thing. For example, we have 3 billion portfolio in CE, and no one is questioning that. I mean, everyone is happy about it. I mean, of course, you see right now also some changes on the political side, but right now, again, back on track, the US, I mean, the US market, I mean, how is Office doing there? What about the election? But this is all to a certain extent past here, and especially, I mean, overall in CE, and that's great news for CE. Of course, it doesn't help for a European player like us if you're also heavily involved in the US, but at least, I mean, CE is doing very good.
Brendan, moving on to you. I think that, looking at outlets in general, they've done extremely well when everyone else was, let's say, in a bit of pain. The outlet centers have done well. Tell us a little bit about your outlet centers. I know you're doing a little bit more developing and refurbishment. Tell us what's going on and how you see 2024 playing out for your sector.
Thanks, Craig. I think the watchword for outlets is counter-cyclical. We seem to do very, very well in the bad times. But what we're seeing at the moment is that, and this is not only applicable to fashion house, outlet centres are doing very well across most of Europe at the moment. Our customer is female, middle class, 30 to 55 years of age. And the income of their households has been, cut by interest rates, by fuel costs, everything else. And as a result, they're running towards value. The customer that we serve, particularly in Romania, we're seeing high double-digit like-for-like growth in our centres in Romania at the moment, because they are not going to the movies anymore. They're watching things on Netflix. They're not changing their cars as frequently. They are running towards, so fashion becomes less important than brand and value, which is what we provide. If you'd said to me 5 years ago that Fashion House West Park on the east side the west side of Bucharest would have Hugo Boss, Tommy Hilfiger, Calvin Klein, Louis Vuitton, Guess. I would have said almost impossible, and yet today they're all there. Company stores trading very, very well. So for us, it's good. On the financing side, we are opening the second phase of Fashion House Palladi sometime in June, financed by a local bank. But on the other side, on the west side, we are financed by an Austrian bank. Predominantly, this is quite interesting, predominantly they've been involved in traditional shopping centres. And it was quite funny because we were having meetings with them occasionally, and you could see the faces on the screens saying, what's the update, what's the news, guys? And they're saying, I suppose you're the same as everyone else, and this kind of gloom over shopping centres, and we were delivering really substantial numbers. So we're very happy at the moment in developing, as you say.
So it's like people are going there for actually buying something because it's a little bit cheaper. And
well, I think there's a factor. If you look at the research, I think now outlet centres, beforehand it was very much a value destination, holidays, school holidays, a day out and everything else. I think now in Romania in particular, the outlet stores and outlet centres are becoming an inline retail asset. I was in what used to be Fashion House Warsaw. It's now Designer Outlet Warsaw yesterday. And you can see there's a bit more of a blend. What does it mean? It means there you have a travel agent there. So outlet centres, which were traditionally, very much brand and value, are coming, they're offering a different thing. In certain marketplaces now, the outlet centres have as much full price current season product as not. We don't go down that route, but yeah, we're very happy at the moment. Yeah.
And I talked to a few of the outlets that are doing a lot more like redeveloping some of their shopping centers. That was some of your, I don't know, competitors, but let's say, and they're building more food courts, where before it was kind of the food court was out, and they're adding more food and beverage. What do you think about that for outlet centers?
The problem with outlet centers and food is that we have 50% of our business between Monday and Friday and 50% Saturday and Sunday. So it's a little bit like, if you have a church, the capacity that you require in the middle of March and a cold Tuesday is different from Christmas Eve. That's it. So that's the big issue. Food is becoming increasingly more popular. Our dwell time is higher. Our dwell time is significantly higher than normal shopping. So you need to have a better food offer. It's always an issue. But very interestingly also now, and we're just about to announce something in Romania, leisure box, big box leisure beside an outlet centre, I think is something that you'll see much, much more frequently. But food, I say openly, food in outlet centres is rarely done very well. There are some guys that manage to do it better than others, but it's an ongoing problem for us because the food operators say, I would rather close Monday to Friday and open Saturday and Sunday. So it's a very difficult flow. It's all about footfall.
So really, it's not the problem of the guests wanting to stay and eat. It's more the problems of the operators trying to fund the Monday through Friday business.
Exactly. Yeah.
Okay. James, let's move on and talk a little bit about your company and your shopping centers and how you see things. I mean, how was it in 2023, beginning, let's say, end part of the year, and how do you see 2024 playing out, or at least starting?
Thanks, Craig. Yeah, look, I mean, we're not dissimilar, I guess, to Brendan's examples here because, literally, since lockdown stopped, I mean, retail bounced back strongly, and we've been, facing for 20 odd years, people saying, oh, online is going to come and kill retail. It hasn't and won't. We have a saying, that retail schemes are the ultimate last mile delivery, and I think we need to acknowledge that people do want to come, they do want to spend their time there, and of course shopping centres, they have a sense of place as well as anything else. So from the retail perspective, we're looking, as we always have been. It's just it's working, things are ticking along.
You know, on the footfall, what do you see? Cause some of the some of the shops are really benefiting or doing well, and some are not doing quite as well. So, who do you kind of see the winners and losers? Who's done better, and who's? I know it's tough to talk about who hasn't done well, but you see the numbers every day. So, what kind of retailers are doing better this year or last year?
Well, it's always the same. The core of retail is convenience. It's what people want to come and shop for, and so obviously the food and the necessities are always the strong bits, the things that underpin. Fashion has changed, but then some of the stronger fashion retailers have reinvented themselves. They've taken on, the fashion is really the area I guess that's struggled a little bit more with. Dealing with physical stores and online, and as I think as the US, some of the Western European examples have sort of come forward as these retailers are sort of operating in Central and Eastern Europe have adapted their strategies. So actually we're getting the benefit of the learning in some of the other markets. So fashion is actually doing quite okay at the moment. Generally speaking, there's probably a slight oversupply in retail, but really it's not an issue. And I think one of the strong things that we've got in this market is that we can actually have some input in terms of how our occupiers trade. So, unlike an office, you can't force your office tenants to for either influence the success of their business by good marketing or whatever, and you can't have any influence about whether their workers come into the office Monday to Friday. Whereas we have some tools by which we can, in the retail world, have some influence, help our retailers, help their customers to come in, provide a right environment, right mix. You're talking about the big leisure boxes, Brendan, there, and it's spot on. We're adaptable, and I think that's. You asked a little bit before about the 2024 and beyond. I think that's where we have to really be looking as how we adapt to that. But generally speaking, pretty good.
Right, great. Ada, we're coming to you now. So welcome to the panel. Tell us a little bit about your company, of course, and what you're doing in Poland. But how is Poland? Let's say, I'm sure you guys have corporate meetings every week, and
Oh yes, we do.
and probably you're a little bit happier there than some of your colleagues in other countries. But tell us how Poland or CEE is fitting into, let's say the European meeting that you attending and talking about numbers and expansion, or what's happening in compared to the rest of Europe.
Okay, so basically what I have noticed, but that here in CE, we are more optimistic. And I think it was also mentioned by some of the speakers before. We are really hoping for a big bounce back. And we see that the footfall is almost there for most of the shopping centers. We see that the turnovers in real figures, they are also reaching the pre-COVID levels. So I think here in CE, in Poland specifically, and especially after I think the 15th of October, we are very optimistic in terms thinking about the coming 2024, more than it is in the Western Europe, obviously.
Yeah, when we were in London, I was talking to a few of the, let's say, Western European investors.
Oh, yes, that was you who mentioned. I'm sorry.
Yeah. That they were talking about. I said, oh yeah, we're doing this retail conference, and they're like, wow, is anyone even going to come? It must be horrible. And I was like, well, it doesn't seem that horrible. Seems like so it really is kind of different worlds with retail. And so maybe to anyone on the panel, why do you think, is there just people spending less money in Western Europe, or why is it so gloom and doom, or is the values dropped, or what's stopping in the shopping?
I think it's still that our market is very dynamic. We are still not that, let's say, mature and saturated as the Western Europe. So they feel it stronger. That's the same thing with inflation. I mean, in Poland, the inflation was really like double digit, and we are happy that it's decreasing now and quite optimistic. Whereas in the Western, where the inflation was really, really lower, everybody was talking about it. So I think that's the base that they are comparing to. This is one thing. And yes, I think that also our market is simply not that mature, and we have a lot of like newcomers in terms of retailers. We have a lot of brands that start here and then they expand to the Western countries. And well, I mentioned that perhaps they are more pessimistic. On the other hand, within our portfolio, I mean within the citrus portfolio, we had the opening of the shopping center Merlata Bloom in Milan. Of course, it was started pre-pandemic. It was, but actually, it was a big success. Also, with a lot of Polish retailers coming in, so there is a lot of cross-border deals that are done also by the Polish brands expanding to the Western Europe.
Well, good to hear, not just taken over by only Italian brands, only selling to Italians. Well, great. Frederick, tell us a little bit about Multi and also how you see Poland. You mentioned Ukraine because I know you've got a great shopping center in Lviv and probably doing better than ever now.
It's a great asset.
I would imagine it's almost net beneficiary of this situation there. But tell us a little bit about how you see Ukraine, Poland, and how you see, and you're also doing France, yeah? Ukraine, Poland, so pretty big area to cover.
Yes, we can say in CE, especially Poland and Ukraine, for me, we can see that shopping centers, they take advantage that there is no high streets. There is no this kind of offer that I can compare in France. A shopping center close to the city center has a great competition on the street. So we don't have that in CE, maybe in Prague or some big cities, but even in Warsaw, I don't see that. So the modern shopping is in shopping centers. We can see the development of retail parks, street parks, closer to the inhabitants, giving another shopping experience. And but we can follow this trend in all Europe when two kind of assets is we can say more successful. The one close to the small one close to the inhabitants for daily shopping, and the big one offering a big customer experience, a call for action to come, and in between. It starts to be a little bit more complicated. We have some time to rethink the scheme, maybe with mixed use, maybe with other with a residential part. We can see this trend. On retail, we clearly see, but all Europe. In Multi, we are in 14 countries, and we see really clearly the discount expanding, even in Western Europe. In France, Primark is very successful. Action for years now is doing a great retail and great results. Teddy is entering France and is thinking about 1,000 square meters of stores. So it's not only, we can say, CE with discounts. But there is more brands in Western Europe that we don't see here. So I think we have still some room to improve in CE. Ukraine is very special. We have a forum Lviv in the center of Lviv. Our team is really under pressure. Bombing is every day, almost, even in Lviv or close to Lviv. They have bomb threats every day. So with evacuation every day, they become we can say, world champion of evacuation, 35 minutes from the start to the end. But this is the daily life of Ukraine. So unfortunately, it's difficult for them.
Even with things going on in Ukraine, people still need to go shopping and even just relax.
But the shopping is doing good. Was doing good. December and January are much worse due to the bombing.
So there was more risk, yes, to go there. Okay, so so Frederick, thank you very much. And you mentioned development of retail parks and more retail parks. I just happened to notice Jacek was here, and maybe we'll give Jacek the microphone over on this side, and Well, sorry, no free visiting. I'm going to call you sometime. So tell us a little, Jacek from Tree. Tell us a little bit about. You just mentioned retail park development. Tell us what's happening on the retail park development in Poland and how you see the market and what you guys are doing. I may call people from the audience if I think you're not paying attention as well. So
Mm, life is always with two colors, you know. This is, of course, much better than for shopping centers. I've been also developing big shopping centers earlier. So the situation which we have now with retail park, I will compare to situation like in late 90s or beginning of this century in big shopping centers. We are in a huge expansion process, a lot of projects still being developed, new tenants appearing. This is all fun. But of course, we have headaches. Um, uh, like, for instance, very strong zloty. We talk about Polish inflation, which was double than Western Europe, but at the same time, Polish zloty strengthened towards euro by 15% probably at some stages. And when we have incomes in zlotys, this is, of course, creating a problem how to finance these projects. That's why this market probably is going to be more and more saturated for bigger players, and this who have an access to cheaper money or just say own cash. By that, we are with some advantage in Tray. We have developed last year 6 projects. This year we are planning 9, so we are in a very luxury situation. And what is driving us is, of course, also e-commerce. We are closer and closer to people. We are to the smaller and smaller city. We are now at the cities of 10,000 citizens. So when someone is clicking something, he in the end collects things from retail park. And also he's giving back this thing. So we are able even to transfer this knowledge about potential e-commerce customers into better rents. So we are able to be profitable even out of customers coming via internet. So all that is good. Question is when market will be, say, strong enough for some transactions, because there is no transactions for, say, 2 years, like in everywhere sector. But demand is probably there. We have nearly every month someone asking whether we are ready to sell something. So this will come. But of course, inflation have to go down, money have to be cheaper, leverage have to be possible, and this is not at the place now.
so the current strong zloty is difficult for development and finance.
Yeah, because imagine we have incomes in euro and you have to pay for work in zlotys. Construction costs went down. It's not a big secret, but we have like in such a joke with a goat who have someone got to his apartment and when he's out it's better. So this increase was like 60% at some stage of time. Now it's down, but still 20 few percent more than before Ukraine war. So here we need more money and we have less money because of exchange rate. And here you are losing some kind of comfort of development by losing contingencies. And that's why, you finally build within the budget, but sometimes you say bad taste left. So it's no fun coming out of that.
And you mentioned a lot of new brands. I mean, I remember, I don't know, maybe it wasn't even 5, 6, 7 years ago, there was some retailers are telling me, oh, we would never go into a retail park. And now I see half of your brands are those same people. So why do you think the attitude changed, or how has it changed?
I think it's purely economy, but also COVID. During COVID, this lockdown hurted very much big shopping centers, while retail parks not at all. So habits changed. People start knowing that whether they will go to retail parks, there is always this project opened. And that is, of course, what supported us. But the main factor is that we don't have common areas. That's why we have no service charge costs very high. When I've been doing with big shopping centers, I know that service charge has been exceeding 20 euro per square meter. We have all costs to half of that. So rent plus service charge is closer to half of that. So then someone have to ask himself, if he's in retail park or in big shopping center, where the turnover in retail park is much lower than in shopping center because of that lower rent, whether it's pays back. what occurring now, people are coming quite often to retail parks, leaving a lot of money there, and this economy of shops is getting better and better. So more and more tenants who are in big shopping centers considering whether they should go to retail park. Also, let's say I will not name these brands, but some brands of clothing, if they are in shopping centers, they have to compete with very strong brands like, I know, Zara, H&M. While they are in retail parks, they are maybe the only ones. So this competition is not that strong. There is one of my colleagues from Gdansk whom I've been convincing to open a store in retail parks for 5 years. Now Sinsay probably is doing well. Mr. Piechocki, can you tell us something about this? Yeah, so retail parks are giving this opportunity of economy even out of smaller turnover, but this turnover in the end is not that much smaller than expected before. That's why more and more brands is appearing now.
And Brendan, you mentioned as well in Romania, you're seeing a lot of, like you said, 5 years ago there wouldn't be Hugo Boss. Now, is that because Hugo Boss wouldn't go there and didn't want to be seen there, or was it just that people weren't? You didn't think they were, or they just thought no one would buy anything there? What was the kind of change in?
In Romania in particular, for many brands in the last 5 years, Romania came onto the radar. It's as simple as that. And I'll use Triumph as an example. So Triumph, the lingerie retailer, in 5 years ago had 27 stores with 13 franchisees. So in an outlet, an outlet tenant really needs something like 5 or 6 stores before you have one outlet store. So, and that's completely changed. So, and we see it with global brands now coming to us in a very particular way, coming to us saying that we know you very well, Brendan. We want to come to Romania. Don't speak to our franchisee at the moment, but the store that you have at the moment is 170 meters. We want to make it into a 350, 400 meter store, outlet company store. That's happening all the time. So the whole and it's not only Romania. So you can see it also in the southern area of Europe has come onto a radar of brands which just wasn't before. For our business, it's particularly good because until 5 years ago, the outlet product only came from stores in Romania. So it was transfer stock that was not sold in stores in Romania, which is a relatively small pool to draw from. Now we have made for outlet product and other product coming from other countries into the outlet in Romania. So it's that's why we're getting this huge growth.
Right. So just a completely different business from just trying to sell the old stock or couldn't sell the
and there's a bit of made for outlet and everything else. Going back to the retail park, my opinion is that COVID pushed everyone towards retail park, and we see it. The customer wants to now come and park as close as possible to the transaction. Literally walk into the door, have the transaction, and then walk back out again. I think they're less inclined now than they were before to congregate and mix and come together in large shopping centres. You were talking about food courts earlier, so I think that's why, and I'm sure everyone's aware, one of the biggest transactions in Europe happened just a few weeks ago in Romania, and it was Mitiska's retail parks, hugely successful. So I think that's a change in the consumer habit where they don't want to be in escalators, lifts, and congregate in large numbers together. They want to drive up to the door, buy whatever it is they want to buy, and then come back out again.
I mean, you
really a trend which remains, because because I'm really not sure, because I think really it's more multi-channel. I mean, if I see spending behavior, of course I agree. Because of lockdown and Corona, you see that people, they don't want to be that close at the moment, but I'm not 100% sure whether that really will remains. Retail parks, they are great in terms of what they are doing business, also discounters, but I'm not sure whether there won't be the time at a certain where you're really people going back, for example, to shopping centers and bigger conglomerations. Not now, but you saw it, for example, also online trading. There was a massive wave going up, but right now, it came down again, and it is something which is important. It's an important element, but it's not the main driver. And I would say the same also about discounters and retail parks. It's important, it's extremely important, but it's not the main channel, I would think, which will be the case in 10 years' time. But I don't know.
Well, okay,
Probably,
I'll
James, you're the expert.
Well, I'll add to that. I mean, we've got a pretty good sample of shopping centres in Poland, right? I mean, we have 1,500 tenants, I guess, all enclosed. Roughly speaking, our sales are 35% ahead of where they were in 2019. Okay, our footfall has now gone beyond what it was in 2019. So, roughly speaking, last year was about 80% of where we were 2019 footfall, and sales were 25 to 30. We're now well in excess of that. So if retail parks are stealing all of that business, then we should be 50% up, but we're quite happy with 35%, right? It's working. People are coming back. Yes, there's less people, but they're spending more, which I think is your example there too, Brendan. So yeah, I mean, it's a multifunctional space, and it's not that easy to sort of put. I think, Craig, you were sort of mentioning people are going, well, why is retail and looking? I think people are wrestling around the whole concept. If you go back to where investors are sitting, they don't know what to look at. They don't even know what geographies to look at. They don't know what asset classes to look at. I think, Chris, we were talking about it last night too. So, are you deciding, okay, unlike, say, 2008, 2009, right, where it was kind of easy, okay, well, the world's going like this, we'll pile into logistics, or offices, okay, and retail was sort of, then things sort of balanced back out. At the moment, there is no obvious choice. The obvious choice is people are going, oh, well, we'll invest in logistics. And they're saying, well, it's overpriced and over-rented now. But, is it the most logical group to go? There isn't an obvious choice. And I think that's where a lot of this stuff's coming. We're just sitting here, we're trading, things are performing, we're happy, the investment market will pick up with it. Dieter, you're correct, we're like various banks we speak to, it's back on the radar because fundamentally the asset class is performing. And I think we need to sort of keep that. The investment market will pick up. We always say there has to be three things in play. Occupiers have to be strong, the lending market has to be strong, and the investor market needs to be strong. The investors are the ones scratching their heads at the moment, right?
Okay, yeah, I also wanted to join the discussion. Well, I think that there are like two major trends, and it's also because of all the changes, all the changes during recent years. So there is one of this convenience retail park, dispersed retail, very close to the house, on my way back from work. And there are also those shopping centers that are places for living, 15-minute cities, mixed-use projects. So all the projects that your dwell time is increasing, that you are expecting more than just shopping. You are expecting also leisure, a strong F&B component. You are expecting it to be your, just your, the place for spending, a place for spending time. So I think those two trends, they are not excluding each other. They are together somehow since the COVID times. And the only problem is really for those middle-sized schemes, which are in between the convenience and the big places for spending time. They need also, let's say, somehow to reinvent themselves because probably they are right now in the biggest problem when we see the statistics regarding the footfall or the turnovers. So what I think is that those two trends will, that's my feeling, they will stay with us for those big lifestyle places and the convenience that is closer to us. And there is one more thing, there is a generation shift. I think it's also important. So the Gen Z is really, I can see it, just looking at my daughter and her friends, they are really spending time in shopping centers, and it's really their place in a more natural way than it used to be for myself, for millennials, for any other generation that was before. Mm-hmm.
Frederick, what is your thoughts on this?
It's, I think what I said at the beginning, that we see really there's two trends in all Europe. And we like retail. I think retail is always changing, adapting itself to the market, to the needs, or to the new trends. We will see new changes. I think we don't know what would be. We'll have to adapt very quickly. This is a very interesting, we can say, asset class and industry, because it's changing all the time. At the beginning, it was only on the street. After we created shopping centers, retail parks, street parks, everything that we feel a little bit the needs of the moment. It will change. I think everybody is waiting and looking what would be the opportunity. Maybe the opportunity will be with this asset class that is suffering now, to reposition. We are looking at it in multi, because we have also our own architects, and they love retail. They love also residential. They did a very good repositioning in Rotterdam. I remember a few years ago that they took an old office building with a shopping center, reshaped it in keeping only a ground floor for the retail services on the first floor, and the old building, we can say, office building was completely refurbished to give premium flats with balcony. This is possible in Rotterdam because the ground is so expensive, the flats are so expensive, but this is a kind of thing that we can do, and we can have opportunity to do.
Craig, can I?
Yes.
Definitely, it will never happen that retail parks will dominate market and there will be only ones on the market. Not at all. So there is another way of shopping, and this other way of shopping will exist parallelly to the big shopping centers. One thing for me is obvious. There is no possibility of building new big shopping centers. And it's not because of maybe even a demand on the market, but I've been saying it already 15 years ago, because I am that old, that turnover-based rents will destroy possibility of building shopping centers. Now, more than 50% of space of big shopping centers based on turnover basis. How to finance this? Then I ask you as a banker. No way. Here in retail parks, market is very healthy. We don't have even a single tenant doing like that. That's why we can prove income easily, and by that there is a big chance for development.
Right, and just a few words. Just thinking about some of the experts talking about retail and shopping centers, and them saying, "Oh, no one wants to be close to each other. No one wants to meet in big shopping centers." But gosh, if you see the ones just in Warsaw on a Saturday or a Sunday, I mean, I'm not afraid to be close to people, but wow, it's really tight. So I think there's, and I don't know if it's, you're right, there's a lot of younger people in there, but I think that was always the way in shopping centers. Probably when they started building them in the 60s in the US, it was, the younger people go and do them. But it just doesn't seem like anyone cares how close they are to each other. But then you go to a conference, you say, it's not going to really work because people are nervous. It seems like nobody's nervous if you go to Zwarte Teresa on a Saturday. If there was some horrible disease, they would all have it. Yeah, because it's very close together.
But of course, I mean, that is Warsaw, right? Mm-hmm. And then it comes to, I mean, purchase power and consumer confidence. Because I think at the moment, I mean, you mentioned it, Ukraine, and there are so many aspects at the moment where everyone is saying, okay, well, then probably I'm very cost sensitive. Yeah, so I'm going to the more discounter brands. You see it also in shopping centers, more and more discounters like half price action and all these. For example, we are also financing shopping centers. It was interesting to see how they started 15 years ago, and right now also where they found right now the attraction, bringing people in, because I mean all the Bidronkers, all them, they brought it into the shopping center, kicked out a few others, and right now it works quite well. But you see that, I mean, that was also what you saw a couple of years ago in Germany and other Western European markets. But I think it will be at a certain point of time, because I mean 20-25 years ago, when there was the first hypermarket and shopping center, everyone was amazed by, I mean, how attractive it was, right? And you went there and you saw the Auchan and Carrefour, and everything was massive. And I mean, they had great turnover. And I think that was a period of time. And then, of course, right now you see something what you already saw on the Western European side. I mean, more cost sensitive. I mean, you focus on costs, right? Discounters. I mean, the cheaper the better, even so. But there will be something what you see also in Germany where you see, okay, you have the discounters, of course. But if you see what they're offering these days, I mean, sometimes it's even more expensive than if you buy it in, I don't know, I mean, at the corner, because they say, well, it's coming, I mean, from nearby, you know, it's high quality. So, and it's really a mixture of what is coming. And that's what I'm saying. And I think that's what you will see as well, where you see, okay, you have these, I mean, neighborhoods, very convenient stuff where you buy things, but you will have also bigger shopping centers as entertainment or destinations where people are going, families are going, people are going. But I think it will take probably 5 to 10 years when you see it.
But these trends are both direction. Who remember today delicatessen stores like Piotr Paweł, Alma, Bomi? Do we have them? No. But look at this Biedronka today. They have 10 times more goods than 15 years ago. They took this place of delicatessen store. So if I'm going with Biedronka or Lidl to city of, I don't know, 20,000 citizens, for them it's delicatessen store.
Yeah, it's interesting too. Just what you said before, Jacek. You know, many years ago in a different life, I moved from Australia to set Westfield up in Europe, and in London particularly, when lease lengths were 20 years, and everything was fixed 5 years, and then upward only rent reviews. And you know, somebody said, "Oh, but you guys from Australia, right? You do turnover leases, right?" And they said, "Where's the covenant?" And the guy I set Westfield up, Peter Allen, a great guy, and he said, "You're looking at it, right? It's the manager." And you know, over here we used to having 5-year leases. Every shopping centre, we've always had turnover leases, but we've always had a base rent. You know, management is vitally important. I think that if you know, I don't want to sing too loudly about the thing, but everyone you're seeing sitting here, Frederick, you had right, you know, we're all managers and we're all hands-on, and this is the key to dynamic environment in retail. And you know, you got the best in the region here. So it is true. You know, we are the covenant, and that's why we've got a great relationship with banks as well, because they know that, they trust that, and our retailers trust us. And I'm looking across at Gosha and also Madja as well. From you know, we've dealt for the last 20 years with all the retailers in this country, and the relationship is very good, and that is important. So I think actually that point about the turnover is important, because you know, you're seeing the covenant sitting right here. You know.
I think in terms of the outlet business, we started, I think we were one of the pioneers of the turnover rent and the upward only ratchet. I think for our investors, it's actually a very attractive proposition, because we have this hockey stick. Our locational strategy is out of town. Generally, we're buying cheaper land. We build a box and we make it very pretty, and then we bring these great brands. But going back to the point earlier, I think if you can demonstrate and prove, you know, management expertise, marketing expertise, retail expertise, then I think the banks are open to that business plan when you've had success before. But for our investors, and we are effectively a closed private equity fund, the risk, they don't see the risk in turnover rents. They just have a different perception, because we've been so successful also in Poland and other with Fashion House. So. Yeah.
The ratchet clause, I think, right now in the regular shopping centers is OCR clauses or something that could be compared somehow to the ratchet clause. So it's somehow combined. But referring to what you have just said, I think that the management in terms of asset management is really important, like the optimization of what we already have. So sometimes it's not about the rental values just to increase them, because we know that from the retailer's part there is a strong pressure on rents, but sometimes the space can be used in a different ways. There could be more specialty leasing that is very good for the valuation of the assets, and basically we need to reinvent not only by increasing rents all the time. It's somehow this is the idea of capitalism, just a constant increase. But we can see that sometimes we need to reinvent the asset just to perhaps increase its value, but not exactly by constant increase on rents. So that's the idea.
At least that was some kind of aspect. The best building in terms of ESG is the one which never gets built. So we need to deal with what we have. And if you go to a city like Budapest and you see the success of the German discounters there, that's only possible in standing assets. There is no much of new assets. And they're just bringing new formats into the benchmark of the consumer perception. And it's so much better than the local ones that they basically sucking in all the turnover into their formats, right? And that happens in Romania. So the CEE is, I guess the success in retail is always based on the perception of the consumer. And funny enough, in this part of the world, if you're asking about the perception of the future, and it doesn't really matter in which age class, with 20 years old, 30 years old, 40 years old, it's much more positive than you ask the same question in Germany, for example. And that's the key, right? So the challenge is the perception, and yes, of course, we have a regulation, but the nice thing on ESG, it's all about benchmarking. So if you are better than the peer group in your submarket, you are already on the winner side. Now the challenge is, if your neighbor is in front of you, you're losing out. So you can't wait, right? You need to be making sure you're on the first mover side and not behind. But I'm 100% agree. I guess creating value in retail has much to do to change the format in the existing asset and create it from the beginning, from the design point, that it's multifunctional and adaptable. And then you have a mixture, right? Because your retailer goes for scope 3. They are only basically 80% of their carbon footprint is based in their goods and products, while the asset manager needs to go from scope 1. He's coming from the asset. And if the asset manager doesn't go behind the meter, or the retail parks of Jacek, if he doesn't go behind the meter and tries to communicate with the tenant who is interested in scope 3, but he's in scope 1, if he doesn't make that working, that you create this ecosystem, you do not create the maximum value out of it. And it's not about the rent, it's really about this add-on.
Okay, thank you. And any other questions from the audience, or any questions from the audience? Oh, over here. Other side of the room.
Imre Vellamaa from RA Technologies. And recently I was reading about Frankfurt office market, and vacancy rate has reached 1 million square meters there. And in related to that, I started to think about the impact of ESG on vacancy. So how do you feel? Does ESG have some impact at all? And is it like a kind of opportunity for a vacant or for a vacancy, or vice versa? It's a very big challenge that may end up with a bear market even. So Hubert, you're like a forerunner of ESG. Maybe you have some good ideas.
Yes. The question is the correlation between ESG quality and vacancy, right? Yeah. Of course, there's a big correlation. The thing is, how do you measure it, right? So how can you prove that the ESG quality is correlating to the turnover for retail or to the vacancy in an office? I always say occupancy doesn't exist in the glossary of ESG. So we are in Warsaw. Going over the street, Wola is the new business district of Warsaw, right? Where Mokotów is sucking. Mokotów was it for 20 years more. Now there is picking Noblina factory. It's a premium real estate, mixed use. It was brownfield for years there. It's mixed use. We have 40 restaurants there. We have 40,000 square meter of offices. We have cinemas and everything. It's basically an urban entertainment center. And there is exactly the problem. So it's 100% leased, but out of this 40,000 square meter, only 15,000 of the offices is used, even though it's 100% leased, and they pay rent. That means it sucks down all the amenities because these food courts don't have revenues because there's no customer. And Düsseldorf Medienhafen, we had that. It's a monolith office area. And it was basically the rising star of North Rhine-Westphalia, Düsseldorf, because it was an old harbor, right? The industry harbor. Now, if you're going there, the restaurants for lunch are closed. They open for dinner time because labor is expensive and there is no enough traffic in the offices. So coming back to ESG, how you can fix that is, yes, if I'm standing out in the peer group of the Medienhafen and I have the most ESG compliant building, I do not suffer on finance, I do not suffer on investors, and my tenants getting more and more interested in that. If you're dealing like brands with Lego, and they're coming from Denmark, of course, and you're dealing with other brands, tenants asking you for your ESG report. And if you don't have the report in place, you will not get this tenant on board. And this is the correlation. And it's getting more. Maybe today it's 25%, but I guarantee tomorrow it's 50%. And the time comes soon in 3 years, it's 60 or 70% when the tenants require, because of the need to report to their stakeholders, what are you doing on ESG compliance? And that summarizes then and results in higher occupancy. Again, if your neighbor is faster than you, you're losing out. You need to be sure you're in the peer group on the first movers.
But for example, if you're empty now and then you need to change something, so it means that you need finances, and why should banks give you some money if you don't have tenants? So can it end up that you just need to sell it as cheap?
ESG compliance is not a matter of cost. ESG compliance is a matter of engagement. The return on invest on the ESG measures is 6 to 9 months on the first place. Only if you touch the envelope, if you touch isolation, if you go for the heavy machinery, then you have a return on invest for 5 to 8 years. But still, 5 to 8 years is 3 times better on a return on invest as a real estate where you have 20 years plus, right? And the finance is available. I'm a founding member of the Sustainable Energy Finance Association. This is energy as a market, energy as a service market. There is money. It's waiting to come to the real estate, but we are not ready to pick it because we don't have the rules in place that they are allowed to invest here. So if somebody has a 200 million green energy fund, he rather does a power plant in Brazil and a battery park or a windmill park somewhere for 2 pieces of the 200 million, each 100 million, instead of bringing 200 investments to the real estate. But the money is there. So if you prepare your real estate right, you get the money. You don't need a bank for that because the return on invest is so high. Go to US. The US American, the average says global warming is bullshit. They don't believe in it. But they say, hey, if the customer requires it and there is business, we do it, right? And that's the part. You do not need to sign up for believing. Just make business out of it. And that's the opportunity we need to grab. And then it works.
Thank you.
All right, well, thank you. And on that note, we will wrap up our panel with any kind of final pearls of wisdom or angles that we missed. And Dieter, if it's okay, we'll start with you. Maybe something on how you see lending in the next year or two.
No, I think, also having bankers here, with Georg from Hellerbar or Wolfgang from Erste, you see banks are there. They're also financing retail. We are taking care of it. It's great to have people like James and all the others on the ground. I mean, factory outlets, retail parks are doing well. I think shopping centers are coming back. You saw already right now first transactions. You see also transactions happening in Romania and other countries. So it takes some time. I mean, everything what is around us, I mean, scarce consumers, so they are not spending that much. They are keeping all their money on accounts and everywhere where they get some interest out of it. But I think it's coming back. It's coming back slowly. And of course, human beings, they are always pushy. And we, of course, are extremely pushy and we want to do business, but it's coming back. And I think 24 will be still difficult, but definitely, I mean, I think by the end of the year, if interest rates are getting lower, and that's what ECB and also Fed are already announced, that they will lower interest rates, and then we get more stability, and real estate needs stability, so we need a stable outlook, and that is coming. And so I think then end of 24, 25, I think I'm positive, and I'm a strong believer for the last 25 years in Central Eastern Europe.
And you mentioned Fed interest rates. They did say they were going to lower them more. At least it implies that. What do you? I mean, you think it's going to be just tiny, tiny steps down, or what do you think is going to happen from that side?
They will wait, yeah, because everyone's scares that if they lower it now, I mean, and then interest rates are picking up. You have the election, which is of course a big issue for them. But I mean, and ECB was late in increasing interest rates, and they will be late in lowering interest rates. But they see how Germany is performing. They see it in other Western European countries, and then they will lower rates, but that takes some time if they are really make sure. I mean, inflation was right now it's close to 3% in Germany. So if this is stabilized, coming down, I think then they will do it. But this is summer or end of the year. But definitely they want to wait, and then they are slowly lowering it. And if they start doing this, I think then we have a more stable outlook, and then also transactions are slowly coming back. I mean, you have more and more local investors here, which is positive sign. I mean, also Czech, Hungarian money is coming also here to Poland, even to Western Europe, and that's a positive sign that brings stability. And all that, I mean, I'm a believer that, I mean, I have a positive outlook for CE.
Yeah, great. Okay, Brendan?
Thanks, Craig. Yeah, I think I agree exactly. I think 24, we will go through kind of, in the same kind of status. 25 and 26, we foresee that the transactions will start coming back again. I think most of you will know Connoisseur on the other side of the river in the Praga district. Huge, fantastic asset of ours. We're trader developers, we would normally have sold that 2 or 3 years ago. But in our plans, we see that 25, 26. But just to leave everyone with a thought, which is something that's very dear to my heart, because we were talking about e-commerce and retail earlier. And Dieter said, which is absolutely true, during COVID, it went through the roof. And like some other panels, I have 3 daughters. And you see exactly what happened. But my view on what happened with e-commerce is very specific. And I'd love to understand the ESG implications of e-commerce. But what I saw was that pre-COVID, my 3 daughters would order 3 things and buy 1. Okay, during COVID, they ordered 10. They still bought 1. And I think history will show in the future that actually what happened with e-commerce was it was just a whole bunch of goods traveling around in vans, being dropped off to houses, being tried on and looked at. Can you imagine that during COVID? And then, I think the statistics show that each item went to something like 3 different homes before there was actually a transaction. So my feeling on the kind of view that e-commerce, went through the roof during COVID, I don't think the pure play sales went through the roof. I think what happened was people ordered a lot more and then sent them all back. And I think the future will show, as ESG comes into real play, that ESG and e-commerce will be, basically you're just transporting millions of items around the country. And I think that, carbon footprint, ESG, will come to the fore in the future.
There are studies in place, and surprisingly enough, e-commerce is better for the environment. Even so, you transport 10 times before you sell, because it's assembled. That means the lorry goes anyway, right? And it doesn't matter if there is 1 good or 10 goods transported. And it will come soon that these lorries are forced to be e-mobile, right? And from that part, according to the studies, it's not as that the e-commerce is more carbon heavy than the retailer on the direct consumer thing, which is also a funny part. Talking about offices, you can build a net zero carbon building. I'm not sure if it's possible, but if you could do it by design, you will fail, because 50% of the carbon footprint of an office worker goes with commuting, and that's true for retail, and that's true for tourism, right? Skiing, 50% of the carbon footprint is driving to the ski resort and back, even so if you stay a week. So I guess we see much more effort in that part due to the e-mobility, but the thing is, as an asset owner, you are impacted today, right? And you need to prove that you did your homework and you have the strategy in place. And as I said on the very beginning, it's not the question anymore if it's science-based correct. It's a political discussion. And that's the problem today, right? So you need to comply if it's correct or not. You need to comply to stay in the game. That's the thing.
Yeah, you see people that are ordering a wooden toothbrush to have it delivered. Is this really ESG, or you buy a plastic one at Rossmann or something? What's better? James?
Yeah, very, very quickly, and I know we're running out of time, so I would just say, I think the investment market, I think in 24 is going to come back. I think there's going to be one fundamental difference. I think we're going to start looking at the cash flow that comes out, the net distributable income, and I think investors are going to start looking at that. They should. So we need to start looking at distributable income, not nefarious valuation yields that we've always looked. It's the disconnect between those and the actual performance of assets is that, and retail is very well placed for that performance. Ada.
Well, I have high hopes for 2024. I really think that the bounce back should be there normally. This is, I think, all the market is hoping for. For sure, we will go with the transformation of the sites, with optimization of value of the existing portfolio that we have in management. But we will also follow the new projects like Wilanów Park or Góraszka, but in a new way. I mean, in a new format. These are going to be mixed-use projects with, as I said before, strong F&B component and also strong ESG component as well, like Wilanów with 2-hectare park, which is going to be available to the public, to the citizens, though it's the part of all the investments. So, well, big hopes for 2024.
Yeah, and I think for big shopping centers, even Ukraine shows that even under duress of being bombed or hit by a missile, they're still coming to real risk. They're still coming to the mall. Yeah, so it shows there's still
They are
lot of
coming
interest.
to the mall. They want to live. They want to live with happiness. So I think it was also the case during the Second World War. People in London were living, were having fun, even when it was bombing. We are living in a different world now with more social media, more information, so more sad information also. In Multi, we are very concerned about Ukraine because of our team, because of our asset, but also for the region. We are really seeing that if it will be a good outcome for this situation in Ukraine, it will stabilize the region and make the region more attractive for investors. We are also very concerned with ESG because we can see that already in France, in the law, we have the tertiary decree. Sometimes a little bit with some contradiction, because we have to decrease very, very dramatically the consumption, but on the other side, we are obliged to install a charging station. So how to do that, how to comply? We are discussing a lot because we have the law in place, and we have the deadline 1st of January 25, which is not the case in Poland yet. So it will come very quickly. Yeah, very quickly.
January 1st, 2025 is around the corner.
So my recommendation is prepare the green CapEx budget. The green CapEx budget is key. The beauty on the ESG, you do not need to prove it tomorrow. You only need to show that you are prepared. The proof is in 2030, okay? But we need to start today. And as you said, if a politician, whatever reason for, comes to the decision, it's activating by January 2025, and you don't have the plan, then you're out of business because you can't be financed anymore, as you are not able to pay back the loan under the regulation of the European Union, right? So it's not a relationship with your bank, it's just poor regulation and you're failing. Not talking about all the money is there. Only believe for a second the carbon ton would not be 80 euro a ton, it would be 400. The 400 is counted in on the Swiss insurance companies. Their business plan says by end of the decade, the carbon ton is priced by 400 euro. So only this money will give you a return on investment on 1.5 years or whatever you do. You know, it's 5.5 years now, right? So, and that's the thing, right? So there's a lot of business opportunity coming up in this context, but you need to start now.
Okay, well, Hubert, thank you for that. And I'd like to thank all of our panelists for your time and effort in this panel. If we can have a big round of applause for our panelists.